Hello, and welcome to Managing Sales Tax in QuickBooks Desktop. Today we'll be teaching you how leveraging automation to manage sales tax with QuickBooks can help you avoid audit headaches and get back to growing your business. So here's our agenda for the webinar. We'll do some quick introductions, and then we'll go over the landscape of tax compliance, the old way of managing sales tax, and how technology can automate the process. My name is Allegra Mitchell, and I'm the Customer Success Manager at Webchillin. I manage our support, onboarding, and account management teams and work directly with the product and engineering teams to ensure that our product suite is delivering the best features for e-commerce SMBs and enterprise businesses. With me today is Drew Jennings from Avalara. Welcome, Drew.
Thank you, Allegra. Great to be here.
I wanted to tell you a little bit about Webchillin. We have a multi-channel platform for e-commerce businesses that helps you reduce busy work, save money, and grow your business. We're compatible with over 70 different e-commerce platforms, including Shopify, BigCommerce, Magento, WooCommerce, and marketplaces like Amazon and eBay. We're an Avalara partner. Unify Enterprise Edition integrates with Avalara Aveattacks to record sales tax in your accounting software. Our goal is to help our customers understand their financial data in order to make smarter business decisions. Our Unify solution brings together all of your e-commerce data to help you with accounting integration, inventory, order management, and fulfillment. Now I'm going to turn it over to Drew, who will tell you a little bit about Avalara, and then he'll teach you about managing sales tax in QuickBooks.
Thank you, Allegra, and thanks everyone for joining the webinar. Avalara has been around since 2004, so we've been in this business for 12 years. We are a sales tax compliance platform offering sales tax calculation, jurisdictional rate assignment, taxability rules. We also manage exemption certificates digitally and provide sales tax return service. We're a trusted provider for billions of sales tax calculations annually, and we process hundreds of thousands of sales tax returns each year, and we remit billions of dollars in sales tax liability annually for our customers. We work with thousands of different software application resellers, CPAs, business consultants, and partners like Webchillin to provide a comprehensive sales tax compliance platform for our customers.
Yes.
So we'd like to know how many states you currently are paying sales tax in.
Now, Drew, I have a quick question.
Time to answer that. Yeah, sure.
I have a quick question. Is it fairly common for businesses to pay tax in multiple states?
Yes, it is, especially now with the growth in e-commerce and companies using multi-channel commerce. So they're not just using the standard retail scenarios that have been typical in the past, but as they're starting to operate in multiple states and use e-commerce to reach new customers, they're finding that some of their activities in those states create an obligation to collect sales tax outside of their home state.
That's awesome. I didn't know that. All right. So how does that line up? Pretty well. I see that the bulk of everyone pays sales tax in one or two states, and a few of you are in 3 or more, so it's good.
All right. So we're going to start off and talk a little bit about the landscape of sales tax compliance, what's happening in the states, and why sales tax compliance has become a really hot issue recently. So what we're seeing is that states are still in the process of recovering from the last recession. You know, when the economy goes down, naturally they see their income reduce quite a bit. And in fact, you know, 31 states are currently projecting budget deficits totaling $55 billion. And with so much e-commerce, out-of-state sales happening, they're estimating about $24 billion in sales tax goes uncollected. So as tax collecting agents of the states, they're looking at businesses and the activities that businesses are doing as a way to generate more revenue. And there's been an increased focus on out-of-state companies in particular and creating compliance risk for those companies who are operating outside their own states. So where are states getting their revenue, and why is sales tax so important? Well, as you can see from the survey here, about 47% of an average state budget actually comes from selective sales taxes and general sales and gross receipts taxes. So this is obviously one of the first places that states look when they're facing budget shortfalls. How are they going to make those up? And since sales tax is the biggest piece of the pie, that's a natural place for them to start. So one of the ways they're trying to make this up is by hiring auditors. So in the past, where businesses don't get audited very often, states are really stepping up their game in this area. And they're finding that for every auditor they hire, they're generating so much positive ROI on those hires that it makes sense for them to really bolster the personnel in that area. So California announced, for example, hiring 100 auditors over the next 3 years. And they're really focusing on companies that are not headquartered in their state, that might be doing business from out of state into their own states and aren't collecting and remitting sales tax. Washington also is where Avalara is headquartered in Seattle, and Washington hired 40 auditors just to go after purchases from Oregon companies, because Oregon's a state that does not collect sales tax. And they're finding that the companies in Oregon oftentimes do have an obligation to collect in Washington, and either don't know it or aren't really aren't staying compliant, and so they're really focused on making sure that the neighboring states, companies there are fulfilling their obligations to collect where needed. The other thing that they're doing to bolster their tax revenue is by adding new laws to the books. So, the list of business activities that create Nexus is growing each year. And if you look at the tax codes of each state, they define the level of activity within the state that creates an obligation for you to collect and remit sales tax. And so, they're expanding that. They're also looking at different products and services that maybe historically have not been taxed, and implementing laws and taxes on these. So traditionally services are not taxed, but North Carolina recently, for example, passed a law on taxing services. So, lawn care services is one area where they focus, but they continue to just sort of expand these definitions of what is taxable in an effort to make up these budget shortfalls. And what that's doing is it's creating an increased risk for a business who may be operating and making sales outside of their main jurisdictions. So when we think about what a sales tax risk profile is, we look at several different items. So first of all is Nexus. This is one of the more important ones. And Nexus is really where you should be collecting sales tax. If you have Nexus in a state, you need to be registered and collecting sales tax in that state. Also, exemption certificate management. If you're making exempt sales, you need to have an exemption certificate on file showing why you didn't collect sales tax on any sale. Because when you get audited, that's one of the first things they look for. Also, product and service taxability. How are your products taxed in various jurisdictions? Depending on the types of products you sell, you may have more risk or less risk. It really just depends. And then making sure you're doing an accurate jurisdictional rate assignment. So really being accurate in terms of which jurisdictions apply to create the proper sales tax rate on any sale you make. And then making sure you're up to date on sales tax returns. Depending on the states you're operating in, some states require local returns as well as a state return. So you really need to stay up to date on that, and also stay up to date on what the filing frequencies are and the requirements that the state impose on that. And then finally, what's your plan for reporting and audit defense? Do you have processes in place that will quickly get an auditor out the door when they come calling? How are you going to defend that audit? And what sort of tools do you have at your disposal to defend that? So let's talk a little bit in some greater detail about these different areas. So first of all, Nexus, where to collect and remit. The notion of Nexus was really defined, well, semi-clearly in the Supreme Court decision of Quill versus North Dakota. And the Supreme Court said, you know, for a business to really act as an agent of the state and be required to register to collect sales tax and collect and remit taxes on behalf of that state, there needs to be a substantial physical presence. Now, the Supreme Court sort of left it at that, and that obviously creates a bit of a gray area that states often leverage, right? So, you know, when you think of a substantial physical presence, some are very obvious, such as having an office or warehouse, having employees in the state. But then some are a little less obvious, and a lot of people get caught when, for instance, if they have a contract sales force or are contracting with installers to install products within that state. Even if they're not your direct employees, even if they're independent contractors, the fact that you have them making sales on your behalf or installing your product on your behalf within that state can give rise to Nexus. And then also regular visits to the state. So if you're calling on a client and you're going there fairly frequently to solicit business, so certain states may say, well, that's a substantial physical presence and you need to register and collect in that state. And then also, you know, the future of Nexus is evolving. There's the notion of economic Nexus. So states are looking at out-of-state companies selling into their state and saying, look, if you're doing over X amount of business in terms of sales in our state, even though you don't have a presence here, you don't have employees here, but you're doing enough business, they feel that that creates a substantial physical presence. And the only way that's going to get challenged is, you know, if it gets up to the Supreme Court. And then the Marketplace Fairness Act, this is an act before Congress. It's been bounced around for quite a few years now. But the notion is creating a universal set of rules to really determine who needs to collect sales tax for out-of-state sellers, particularly in an e-commerce environment. It's unlikely anything will happen with the Marketplace Fairness Act this year as it is an election year, but it's something to keep an eye on and monitor because it could have a significant impact on the requirements to collect sales tax if you're an out-of-state seller. So here's a quick checklist that you can kind of look at to determine whether or not you may have created Nexus in the state. So if you're based in California, but maybe you've got traveling salespeople in Nevada or contract labor, how do you promote your products and services? One area that often generates Nexus is affiliate sales. So if you have affiliates in the state that you're paying commission on generating sales, that can create Nexus in those states. Also, one area where people get tripped up is participating in trade shows. If you just go attend a trade show, likely doesn't create Nexus, but if you have a booth and you're selling products within the state, it likely does. And the list of rules around this grows every year, so you really need to be constantly assessing your own business activities to make sure you haven't created Nexus unintentionally. And then identifying and managing exemptions. I talked a bit about if you have exempt sales. A very frequent scenario is selling a product to a reseller, so acting as a wholesaler, and that's a use-based exemption. The other is an entity-based, so if you're selling to governmental agencies, oftentimes they will be exempt. And this is just really important that anytime you have one of these types of exempt sales, that you collect and maintain a valid exemption certificate on file to justify that exemption. Because if you're audited, that's one of the first things they ask for. They want to see all your exemption certificates and a list of all your exempt sales. And if they don't match up, they will say you should have collected sales tax and charge you interest and penalties for not doing so.
Hey, Drew.
The next thing.
Drew, I actually have a question from a viewer here. They want to know how Avalara helps determine where where their company has Nexus?
So there's a couple things we do. Number one, every company we talk to, and if they're calling us with questions about our product and service, we go through kind of a standard checklist and ask them a lot of questions about their business, what sort of activities they're doing that might create Nexus. But if they really want to be sure, we do have a professional services group that does Nexus studies. So we can actually offer that as a service on top of our compliance platform.
Great. Thank you.
You bet. So the next area to consider is product and service taxability. So what are you selling? Different states treat different products very differently, and what is taxable in one state may be exempt in another state. And then even within a state, different products that are very similar with slight variations can have different taxability rules around them. So an example here is the difference between a Milky Way and a Milky Way Dark. To you, they both, and to me, they both sound like candy bars that should be treated the exact same way. Well, in fact, in some states, because a Milky Way has milk in it, it's considered classified as a food item and therefore becomes non-taxable. Whereas a Milky Way Dark, because it doesn't have milk in it, is classified as a candy item. And these sort of rules come up all the time, and it happens not just in food items, but also in clothing and others. Some really good examples here that you can see for varying taxability rules are in the area of software and hardware and digital goods. Services is one of those areas that's very different from state to state, what services are taxed versus exempt. Unless you're a CPA or an attorney, they have great lobbies, so they're always exempt. But if you're, hairdressing, spa services, lawn care and maintenance, things like that often can be taxed. And then food and beverage and clothing apparel are some that are often have a lot of different rules around them. So if you are selling any of these types of products, you're going to really have to stay on top of the different rules around how the products are taxed. And so the next step is, okay, so I know where I have Nexus, and I know what products I have and how they're taxed. What rate am I going to be charging for this? A lot of people use tax tables based on zip code, and that gets you about 80% of the way there. But if you really want to be accurate, a zip code isn't going to get there. A zip code was designed by the federal government for mail delivery, and that's it. And taxing jurisdictions are based on completely different boundaries, and those boundaries often change. And so really understanding what jurisdictions apply to any address in the country is very important. And what we'll do here is give you an illustration of how complex that can be depending on the state. In this case, we're going to focus specifically on Colorado. Colorado is a home rule state, and which means that the local jurisdictions have a great deal of control over the tax rates. So as we kind of zoom in here, you can see we're in Commerce City, Colorado right here. The different colors actually are different tax rates. And you can see on the same block, on the same street, two houses right next door to each other that look the same from this rooftop view can have different sales tax rates. So if we look at the house in the yellow section, you can see that they're paying a 4.85% rate. So Colorado state tax, Adams County, and a couple Denver area taxes. But if you move on to someone in the red section, they're also adding the Commerce City tax. So they're paying 8.35%, which is almost 4 percentage points different. And those are two neighbors that just happen to be in different taxing jurisdictions. So you can see how complex actually getting the right tax rate can be depending on what state you're operating in. And you can, from this slide here, you can see in the background a real patchwork of different sales taxing jurisdictions. Each different color that you see on this map is a different taxing jurisdiction with a different tax rate. And when you start adding up all the different mailing addresses you have, jurisdictional rules, exemptions, and taxability rules, it really becomes a very large patchwork and complex thing to manage. And we are now to poll question number 2. How do you currently manage sales tax compliance?
Now, we've certainly seen, Drew, that tax compliance is pretty complicated. Are you manually looking up every state? Are you using an automated system? Some of you may have purchased tax rate tables, and perhaps some of you aren't managing your tax compliance at all. And that's totally okay if you're not exactly sure. So also, Drew, I have a question for you. How do you normally see in businesses, or what do you normally see in businesses that come to Avalara and how they're managing sales tax?
Well, most of the people that come to us have been doing it manually, and they're realizing that it's just too much to manage and be accurate. A lot of times people have just gone through a sales tax audit and they've found errors, and they didn't even realize that they were making these errors. And so they come to us to help take that burden away. And we'll go into a bit on what the burden of the manual process looks like. And they're looking to us to say, hey, we want to be sure we're compliant, and we don't want to spend a lot of time doing it. How can you help our business this effort, which really doesn't add to the bottom line, and it's just sort of a drag on the business? So, it's very typical for people to come to us after an audit in particular, but hopefully folks on the call haven't had to go through that process yet.
and that's right on target with our current results from our polls. I see 38% of our viewers are manually looking up every state.
Yeah.
And then we've got 19% of those, of our listeners aren't sure. And we also have 30% of our listeners using an automated system.
Right, right. Well, I'm just going to very quickly go through, we've sort of given some hints at what managing sales tax the old-fashioned way and doing it in a manual process looks like. But, what you really need to do if you're to manage sales tax compliance properly is you're going to have to check with each jurisdiction that you operate in and see what their filing requirements are. You're going to have to make sure you're on top of all the sales tax return deadlines and being aware of any filing frequency changes. And then also you're going to be needing to file returns not just at the state but also local level if you're working, if you have Nexus and home rule states. The other things you need to do is continue to make sure that the Department of Revenue's checks have cleared, and really understand that the consequences for doing things improperly can be pretty onerous. And in doing all of this, it really adds up into a lot of time. So you've got to be researching the rates, building your tax tables, managing your certificates, doing your sales tax returns. The Aberdeen Group in 2011 did a study that estimated that the average company spends, what do we got here, 41.9 hours a month on average managing the various tasks associated with manual compliance. So, and all of this is time that could be better spent doing things that actually contribute to the bottom line of your business, not on compliance efforts, right? So, obviously we recommend you use a technology platform to automate this process and to free up the internal resources to be doing other things. So the advantages of using Avaattacks with your QuickBooks installation is that you're always going to have up-to-date sales tax rates. The product taxability rules, we have thousands of managed tax codes, and we map those to your item codes in QuickBooks so that anytime you do a sale, we know based upon the tax code how that product taxability is treated in the jurisdiction it's being sold in. We also keep up to date the sourcing rules. So, sometimes if you're selling within a state, the tax rate is determined based upon the origin versus destination. So we do that all automatically. We also account for any tax holidays, especially around now, like around back to school time. Some states will have tax holidays for certain products to help people with back-to-school shopping. And then we're also a single platform that can manage compliance for all your sales channels. So not only do we work with Webchillin and QuickBooks, but over 450 different platforms, ranging from e-commerce, CRM, quoting systems, ERP, accounting systems. So our goal is to be able, anywhere a sales tax calculation needs to be done accurately, we have an integration already ready for you to integrate into your tools that you're using day to day. So really quickly, how Avaattacks works in QuickBooks is once there's a little piece of software we call the connector, and when you buy Avaattacks, you get the connector, you install it on your QuickBooks desktop instance, and Avaattacks actually becomes a menu item in your QuickBooks product at that point. And when you create an invoice, all you do is set the tax jurisdiction at the bottom to Avaattacks. And what that does is when you save the invoice, it triggers, it tells QuickBooks to go look at Avalara to get the right sales tax calculation. So when this invoice is saved, it'll bundle up the information in the invoice, send it up to our system where we will accurately determine, based upon the address, the exact tax jurisdiction. We actually convert that address into a latitude and longitude to make sure that we're getting the exact taxing jurisdiction. So in that example earlier in Colorado, we know based on latitude and longitude exactly which house we're looking at and which jurisdictions it falls into. And then we also apply the correct taxability rules for that jurisdiction and return the sales tax back into the invoice. All of that gets done in under 0.4 of a second. Now, since we have that data up in our cloud for all your transactions, we're able to automatically file the returns on your behalf as well. So instead of going in and filling out the tax returns for every jurisdiction you need to file each month, all you need to do is log into your Avalara website, go into the sales tax return section, and we'll show you for all the jurisdictions where you have Nexus how much sales tax you've collected, how much of that is due, and what your return filing calendar is. And so say you're filing in 5 states, we show you your total tax liability across each of those jurisdictions and give you a single amount that you remit to us. We then file the returns and remit the funds directly to the states on your behalf. So instead of taking hours to do all these returns, it's more of a 15-minute job to go in, reconcile our transactional data with your general ledger, and then with one click, we'll take the funds, file the returns, and disperse those funds to the states. And then at the bottom here, you can see this is just sort of a conceptual notion of the jurisdictional and governmental rates and rules being fed back into our platform. So that's how we work as a cloud. So thinking back to that risk profile we talked about, how does Avalara address each one? So with Nexus, like I mentioned in your question earlier, Allegra, we do a detailed business review with the Avalara sales staff to identify where red flags are. Those guys don't do provide the actual advice, but we can guide you a lot and help you identify whether there might be a lot of risk there. If there is, you may want to engage our professional services team to do a Nexus study. Then there's exemption certificate management. We have a platform called CertCapture, which integrates with Aveattacks to digitally store and maintain all of your exemption certificates and give you the tools to send out requests for updated certificates if they're out of date, and provide a warning if you're creating an exempt sale within QuickBooks, if you don't have an exemption certificate on file, to warn you that you should collect that exemption certificate or else you won't be compliant.
That's actually a really great way that Avalara approaches kind of assessing the tax risk and the profile of a business. Thank you for that, Drew.
Yeah, absolutely. And then,
so we're actually going to proceed to our closing slide as we are out of time. Thank you so much, Drew.
No problem.
For this really great presentation. So that about does it.
Thank you very much.
Yes, that about does it for today's webinar. Thank you everyone for joining us, and thank you so much, Drew, for sharing your expertise.
Anytime.
And you can also register for any upcoming sessions and watch our on-demand webinars on our website at webchillin.com. I'm Allegra Mitchell with Drew Jennings, and this has been Managing Sales Tax with QuickBooks Desktop. Have a great day.